Okay, everybody, welcome back to the More Doors podcast. Super excited today, episode 59. I am back in the studio with my amazing co-host, Mr. Force, and we have an amazing guest, one of the OGs in multifamily. He is here to share his stories and wisdom with us. We'll get into that right after this. All right, folks, welcome back. Man, I am pumped to be back. I've had a very hectic travel schedule the last few weeks. I missed you, bro.
I missed you, man. It feels good to be back in the groove.
Absolutely.
I feel like I haven't seen you, period, in a while.
Since the Yankees clinched the ALCS and UT couldn't get it done.
The world is different now.
The world is different now. Wah, wah.
Yankees go down in 5. It's okay.
Sad stuff. It's all right.
We're
There's
just a
always
couple
next year,
pieces away.
right? That's what we're all saying in the dugout right now. There's always next year.
Mm-hmm.
But I don't know if we're going to be able to afford Mr. Soto. But we'll find out. Who knows?
see.
Maybe Hal goes deep into his pockets. We don't know.
We don't.
We don't know. But anyway, back to the show. Super excited today. We have an amazing guest. Great friend, amazing colleague, industry titan, Mr. Andrew Bowen.
I don't know how I'm going to live up to this. Like, I appreciate the positive feedback, but I don't know how I'm going to live up to Titan. I mean, that's
industry titan. We're upselling today. Everything we're doing is upselling today. Before we get into our discussion with Andrew, let's take a Brian Force moment and talk about our sponsors for a second.
Our sponsors. It's so good to be back. TourStudios.com. If you haven't been over there, it's probably because the website is down. But by the time this show is up, ToreStudios.com will be back up and running in its new form. Check out TourStudios.com for all your multimedia podcasting, YouTube content creation needs, and then head on over to DeepBlueRE.com, the home of Deep Blue Capital. Make sure you create your investor profile. We've got a lot of educational content over there and a lot of access to our upcoming deals and offerings. So check out DeepBlueRE.com, the home of Deep Blue Capital.
Love it. Nice job, dude. Dude, you didn't skip a beat.
There were no notes there either, by the way. I just want to point that out. If those are just audio, that was all very well done.
I appreciate that. Like riding a bike.
Nice. Awesome. Well, let's jump in. We are here with Mr. Andrew Bowen, currently SVP of Strategic Partnerships at LeaseLock. We're going to find out what exactly that means. I don't want to do you any injustice, Andrew. I'll give the listeners just a tight overview. Started off in multifamily, right? Made the big jump into software. Had an amazing career in software, and now you've taken over as part of the senior leadership team at LeaseLock. Why don't you tell our listeners a little bit more about yourself and a little bit about your journey?
Sure. So, I mean, I have the classic starting journey in multifamily housing, and that's starting off by getting a degree in aquatic biology with an emphasis in ecology and evolution.
Done. 100%.
Yeah,
Makes perfect sense.
I had some great ponds on some of my properties, and I have a fantastic fish tank now. But I actually started my career back in student housing, way back in the day. I became an RA, and now everyone calls them CAs, but it's the same thing.
Yeah.
And did it, unlike most folks, like people will go into that often saying like, hey, I want to get my housing for free, et cetera. And it was a benefit. I actually saw it as a way to get into leadership, and saw the other areas and everything else and got into it and have never looked back, actually. I kind of fell in love with the business side of it. And business, I mean by the operations side of it. I had no clue on the investing side yet. And once I realized that running a business was very much like ecology, which is all about how do things interact, and if I change one thing, it affects something else, et cetera. That's what kind of sucked me in, and then got recruited into the multifamily side down in San Diego. So I had some terrible properties. I had property that was literally on the ocean in Santa Barbara. That was where I started as an RA.
Sounds horrible.
It was terrible. I mean, to be able to go surfing as a study break was a terrible thing. No one should go to UC Santa Barbara. But then, as I entered multifamily, was on a community that was on Coronado Bay in San Diego, and I worked for a company called Oakwood back in the day, where they did both corporate housing or so really fully furnished housing and traditional housing, and worked my way through that organization for 7 years or so, up and down the West Coast. Ended up being district manager for their San Francisco division. Went right during the dot bomb era, which was a great time to be in San Francisco. I learned more lessons in that year and a half. And then ultimately worked my way through corporate housing and landed in Texas, where I ended up going back on the operations side of multifamily for a fully integrated shop where we did everything from development to management, which was really cool experience because you got to see every element of the business. We had about 5,000 units or so. It was a company that got bought by Camden way back in the day. In fact, it was like probably the first portfolio deal that started bringing people out of the Great Recession in 2010.
Yeah.
And that was also the reason that I ended up getting on the software side. I kind of saw that writing on the wall. We tried to, like a lot of people are probably facing right now, we had a lot of deals that were underwritten and financed at the wrong time. We were up against our 3 to 5 year window on most of them. General part or limited partners were trying to get back out, and it was kind of the exit that we saw. Ended up getting recruited on the software side and spent 14 years, kind of going from what originally was called a product sales rep, which is, someone who really focused in on one type of product. At the time, it was really revenue management for me. But then was able to bring multiple different products to market, work through into what became an industry principle, more from, hey, how do you get a deal done, to still doing that. A lot of how do you get a deal done, which I'm still doing today. But also thinking about, okay, well, what's next for the industry? Like, the thought leadership came kind of organically with the group there. And it was a lot of asking questions like, so what and what if? I got to sit next to some of who I consider the real titans in the industry. I stand on the shoulders of giants in that regards. But the market economists and the data science officers and the product officers and all of these people who are not only thinking about the way things happen today, but okay, how can we bring new and exciting things to the multifamily industry, both ownership and operations, to bring the next best thing. Right. So that's long-winded way to get all the way around, and then got recruited to come over to LeaseLock for this, as you said, the SVP of Strategic Partnerships, where again, going from software over to insurance, and I'm sure we'll get into it, but thinking about, okay, what's the future of protecting ownership, and their bad debt exposure while still making it renter friendly and renter centric. So
love that, man. And obviously we want to get specifically into that with LeaseLock and everything, but as a more general sort of question, with all of your experience on the tech side and the software side, how much has the industry evolved as far as the tech stacks and the tool sets that you've been in? And then what are you really excited about moving forward?
Okay, so I got to say, since I've been in it, I'm without exaggeration, my first property on the multifamily side, we had paper ledgers.
Okay.
So when you think about how it's evolved, it's evolved immensely. I think it's become significantly more complicated, especially for site teams. And I think that the next evolution of that is going to be the simplification, particularly for the site teams, through either automation or AI, or what I would call standardization, specialization. A lot of people call it centralization. Most of the models I see that are being employed are completely decentralized.
Yeah.
It's, hey, we're taking very specialized roles now. So in that regard, I think it's evolved immensely. I also think that it has been incredibly slow and resistant to do so. Every new technology that comes out, there is this angst of, can we actually put this, and is it going to overcomplicate our site teams' lives? Right. And by the way, that's a legitimate question. People need to ask that. But yeah, it's to answer your question. It's evolved immensely.
Yeah. Let me double tap into that for a second. So I've been in software now for 15 years. There are certain industries that tend to be early adopters and very technology dependent, right? If you look at, online banking as an example, right? Up until 5 years from now, you still had to 5 years ago, you still had to go to the bank, deposit a check. Now you can take a picture of it, right? And it hits your account the next day. Why do you think the multifamily space has been kind of resistant to some of that change or slower to adopt? Is it the market? Is it the people? Is it a combination thereof?
That's a great question. It's something I've thought a lot about over the years. I think people definitely has an issue. You know, one of the things I absolutely love about the operations side of multifamily is it is one of the very few industries that I can think of where someone without a college education can walk in and has a career path to a six-figure income. And I can point out a number of different presidents and CEOs in large operating firms that started off as either a housekeeper or a porter. You know, it's a fantastic storyline, and I love that. It also creates difficulties when you're talking about implementing technology on that site level, which is where those tend to be the most prevalent on that. So I think that is number one, an issue. Number two to that, I think, is the margins, especially on the operations side. You know, the margins are razor thin. You know, they're operating on a very small percentage scale on that. So anything that's going to eat in that margin that isn't also delivering a clear return is very hard for them to invest easily in. And I said that would be my biggest lesson from being on the software side as well is if you have a technology you're trying to bring into the space and you cannot clearly communicate what is the ROI that as an operator you're going to receive, or as an owner that you're going to receive, and it's so important to you that you'll tell your operator to use it, you've missed the mark yet. You got more work to do.
Yeah. The cost of being the first mover is pretty high, I would imagine, because if you can't clearly identify, you can't clearly have that messaging around why it's beneficial for you to gravitate your entire thousands and thousands of door portfolio to this new way of operating, then you've spent all that dev money for no return.
Yeah.
And it could sink you.
Yeah. I mean, I was talking to someone who's coming into the BI space recently, and when we launched, when I was part of a business intelligence launch earlier, it was actually probably the hardest platform I've ever worked with to define an ROI. Because the ROI is different for every organization.
Sure.
They're going to use it and find efficiencies in very different ways, or find insights in very different ways than someone else might.
Right.
And that one was probably, again, the hardest one to get to.
How much do you think, obviously AI is incredibly unpredictable what the track from here looks like, and the implementation in case study or use cases and things like that. But you know, with things coming down the pipeline, like more AI integration and stuff like that, do you see the tech stack shrinking and becoming less specialized and more holistic over time? They can do more things and you have fewer tools plugged in.
I see it going one of two paths. I either see that happening or I see exactly the opposite happening.
More specialized.
Yeah. And I think a lot of that candidly has to do with the way that the industry is being perceived and potentially legislated, quite honestly. Because there is this perception and narrative out there that bigger necessarily derives worse.
Right.
Like worse outcomes.
Right.
Which I personally don't necessarily believe in that. And I think there is definitely an opportunity for the tech stack to shrink. You know, for example, I know a lot of the organizations out there are building large language models basically as their help chatbots at this point. Okay, do you need a learning management platform as robust as you typically have with 15 different courses on how to use that particular software when you could literally interact with it saying, how do I do a move-in?
Right.
You know, so in that regards, I can see it consolidating and shrinking. Yes. Right. I think it's always going to slightly expand because there's so many people with so many good ideas out there, and there's so many ways that we can use, you know, AI and specialization. And I think that part of the specialization does become down to, okay, how much of that can you offboard to an AI that you trust?
Right.
An example I think is ripe for it is, and this is a dangerous one for people to, especially as owners, I'll ask you guys how you feel about it. You know, accounting is a set of rules.
It is a predetermined set of rules, which is ripe for it.
That's what machines do really well.
Better than humans.
But as owners, would you trust it?
That's a really interesting question. I've actually thought about this, not terribly deeply, but I think as a general principle, I think about this the exact same way as I think about things like self-driving cars. The argument with self-driving cars for a lot of people is they're not perfect. They make mistakes. And my answer to that has always been, right, but on what level, right?
Yeah.
Out of 10,000 times you get in a car, what is the error rate on the average human being ages 16 to 85 or whatever the end of your driving career is, right? Is it better or worse? Because if you say that, so-and-so makes mistakes and that could cause fatal accidents, you'd have to compare that to what the existing platform looks like. And that
Right.
we're all driving and texting now at the same time and all that type of stuff. So you're not looking for perfection. You're looking for leverage and better efficiency, right? If I'm not driving, can I do it as safely as if I would? But also, what can I spend that time doing? And how does the world evolve from there? So I think the same rules apply. If you go into it with a mindset that mistakes are going to happen and then that's a bad thing, well, you, by that logic, would have to compare that to what is the average efficiency rate of the accounting industry as a whole as it pertains to multifamily, and how many mistakes are we already making? What does the lift look like? And is it marginally worse, marginally better? And what is the ability for it to improve over time? Because that's a delta that's kind of intangible. But I can tell you that the ability of an AI to learn and get better over the next 10 years is a hell of a lot better than human beings as a whole ability to get better and better and better over that same time period.
And let me pile on to that. So I think specifically with accounting, I think it's a tough sell, right? If you go it from a purely emotionless perspective, it makes sense. To your point, it's a lot of rules. However, if it was that simple, why do we all still call our accountants at tax time, right? Like, I don't know about you guys. I feel the need to have that conversation, right? And kind of walk through everything. And at what point does the AI kind of become smart enough to consult with us? Right? Before filing your return or putting together your final statements, et cetera.
Well, I think you just brought up a really good point of where I think AI doesn't come in the conversation. And that is the strategy. So what you're talking about with your CPA is, okay, what's the strategy we're going into this? And obviously this is real estate. So one of the things that we focus in on is, okay, how can we minimize the amount that we pay in taxes, legitimately, and by utilizing those. But the actual end of the day processing, here's my general ledger. Here's all the invoices that came in. AI can do that.
Yeah.
And do it well. But I do know that from having years of conversations with management companies, one of the things that they prioritize the most is, and they should, is making sure that those books that they're turning over to their owners are as accurate as, in their case, humanly possible. So that's where I think there's a resistance to the AI in that one, because it's such a high value deliverable for them to the owner.
Right.
And the learning curve is, I guess, in a lot of ways dependent on the dissemination of information around tax codes and changes and things like that. Federal government doesn't do a really great job of putting it in a neat little box where AI can just go, oh, here's everything that I need to know this year.
Yeah.
So its ability to learn might be a little bit limited in that regard.
Yeah. I mean, you say you talk to yours around tax time. I talk to mine more often. That is my father-in-law.
Oh,
so,
boy.
But it's like, I've seen him and the efforts that he goes through to be able to keep up with that code year after year and the changes that happen. And it's immense.
Yeah, I can imagine.
Yeah.
Wow.
Let's segue a little bit here. So you just got back from Optech.
I did.
How was that?
It was one of the best Optechs I've been to.
No kidding.
Yeah. And I got to give a shout out to NMHC. And I was thinking about this because I went to my first board of directors meeting in the fall. And when you think about the meetings that Optech puts on the NMHC puts on, Optech annual meeting, fall board of directors, student, they're so incredibly different from each other. And Optech is always a great one because it's obviously focusing in on operations and technology. But yeah, and there's some really good releases. Shout out to Bazzuto and Ven. They did a fantastic job promoting their partnership and their new thing, and they really focused the week beforehand This year at Optech, there was a lot more of this going on. You know, podcast recording. We dropped one on Unscripted, but it's really kind of fun to have those conversations. But I think the biggest thing that I was excited about with Optech was NMHC's announcement of RETC. RETTC. Forgive me, I don't remember. It's Real Estate Technology something Council, and I'll blank on it. But it was all about how can the industry be better at advocating for the industry and advocating for technology within multifamily. And I know this is going to continue on because I've talked to the folks over there and they were very clear about it. But we had an entire day of advocacy, and bringing in Senator Warner, who is a longstanding senator in there and the head of the Security Commission, and having him talk to us about the challenges and how he sees things. The head of the FCC, where there is actually, a bill in front of it now that has some pretty significant implications to bulk billing, particularly on broadband, et cetera.
Yeah.
And then multiple different panels of either staffers on the Hill. And we, those who chose to participate, we jumped in buses from the Gaylord and literally got bused to the Hill. Wow. And had various different meetings with staffers. Like I happened to be involved in the one that was with the Republican side of the Committee on Commerce for the Senate, and where we had a long conversation with a couple CEOs for broadband folks, and there were a couple lawyers from NMHC and representatives. There was a representative from Camden, a representative from JPI. I was there with LeaseLock, where we could have conversations with the staffers, educating them on, okay, here's our perspective on these issues, whether it was, as we were talking about earlier, AI,
right.
in the space, or, the access to broadband connectivity, or affordability. And it was a really, really great experience in that regard. So a little bit different than other Optechs, but to me, that was the biggest takeaway is finally getting us to, as an industry, punch a little harder when it comes to government advocacy.
Yeah. I think that's really important. We talk a lot about, there's so much noise about the lack of affordable housing, right?
Yeah.
But I also think there's really a huge disconnect between the people, the community, the employees, the residents that multifamily represents, right? And how do we get heard when policy is being considered? Because there's a lot of stuff that happens at the government level that really trickles down to us as owner-operators, right? And our residents that we have very little say in, and frankly, I think we have, the government has very little knowledge of.
Yeah, and it's changing the narrative. Like one of the things that I've been passionate about for a long time. My parents were both lifetime educators, so they both were college professors in California, and I have actually seen the way that multifamily housing on an institutional scale has benefited teachers, because I've been blessed that my parents and their pension have been enough that I haven't had to worry about, where's mom's rent going to get paid from? Yeah. Exactly. And, every time I met with the folks at CalPERS or these other, institutions, they're investing for people like that. And that story doesn't get told enough.
Yeah.
When you're thinking about, the potential restrictions on, the ability for institutional ownership, quote unquote, in the space, and it's okay, anybody with 50 units or more. I'm guessing y'all fall into that category.
That what counts as institution? I didn't know we were running an institution around here.
Yeah, absolutely. But I mean, that's the narrative. It's like, great, all these people that were serving as residents, very often as owners, were also serving.
Yes,
because that's the story I want to even amplify even more. Yes, do we need more affordable housing? Yes, little a affordable and big A affordable. Mm-hmm. We're underserved in this country by an estimate of 3 to 7 million, depending on who you're listening to. But again, that vehicle for yes, it's a vehicle for wealth building, but it's also a vehicle for supporting ongoing pensions and retirement funds and all those things. And I don't think the folks on the Hill, whether that Hill be in Washington, D.C., or in Austin, or in Sacramento, or candidly in Richardson, Texas, the local level, I don't think that story gets amplified enough, and they don't hear it enough.
Yeah. Well, so in that vein, obviously that story doesn't get told enough, and the levers that you need to pull to make affordability happen, make it a reality, they come on the operating cost side, rental rate side, create affordability by making it more efficient for operators to offer properties at an affordable rate.
Yep.
that's becoming more and more difficult. In your thoughts and your conversations on the Hill and having, those advocacy days and having those conversations, is there enough of an understanding at the governmental level of the challenges that operators are facing when it comes to things like insurance, stuff like that, right? Like creating affordable housing we're facing a lot of headwinds. And the story that doesn't get told is, well, I should say, the story that does get told a lot of times is greedy institutions raising rents.
Right.
The story that doesn't get told is significant operating cost increases over the last few years and people doing the best they can to offer the best resident experience they can at the most affordable price. And it's getting harder.
I completely agree with you. And I think that where I think the story does resonate and I think is relatively well received is around insurance. Mm-hmm. But that's a very narrow category. Now, granted, it's a category that's increased massively recently. But I mean, it's very hard for legislators to ignore insurance companies pulling out of an entire state.
Right.
So that's why I think it's there. It's very hard for them to ignore that, the cost of insurance for homeowners is doubling in states that are getting hit by hurricanes.
And even ones that aren't, that contagion effect of people in the Midwest premiums increasing because the same companies are getting killed on the coasts.
Right.
And so they've got to make up those premiums somewhere else.
Yeah. I mean, it's an insurance company. They have to be able to bring the premiums. I work for an insurance company.
Right.
You have to bring the premiums in order to be able to pay them out. Other than that, though, no, I don't think they know it well enough.
Yeah.
And again, when you think about, like, if you want to hear, and I don't remember the specific numbers, but the numbers were mind-boggling. The amount of money that NMHC, for example, is able to bring in through political action committees for lobbying relative to tenant groups. It's like 50x.
Really?
Without exaggeration, yeah. So they punch a lot stronger. Mm-hmm. And they punch on more levels on this. That's why I was so happy to see. And this, by the way, this is something that I haven't been doing for a long time. I'm not an expert on this. I had my eyes opened to it back in a couple months ago and have really kind of beat myself up over it at this point. I'm like, why haven't I been doing more, both on a national, but also a local level, other than LinkedIn posts and thought leadership, that kind of stuff, but actually going in and talking. So the simple answer is no, they're not as aware of it as they don't understand the operational margins are so small, in this business. The other thing that fortunately they're starting to climb onto is if you're going to deliver a bunch of affordable housing, that's got to come from the supply side. And the cost of building at this point from an administrative perspective is too high.
Yeah.
And the one thing I would also think that they're starting to get, but again, you're talking about elected officials. They understand that NIMBYism is an issue.
Oh yeah.
They definitely understand that. But again, you're talking about elected officials. So if all those people are voters,
right,
how do you play that game?
Mm-hmm. Yeah. I mean, there's so much there, so much to unpack. I mean, I got to vent for a second. So you talked about insurance, right? So we're literally, we're doing a refi on a couple of deals as we speak. We signed a renewal on one of the properties in September. So we acquired this asset 3 years ago at like $750 a door in insurance. We just renewed at $1,200. And after Fannie gave us their insurance requirements, the first quote we got through the door was $2,000 a door.
Jeez,
right? Like I think the residents themselves don't understand that, right? No. The greedy landlord, I just gave you my $1,500 a month. You just made $1,500. No. Right. Let's stop right there. Right. Between all the expenses, the mortgage, the whole thing. But like, we don't get to pass on that 60% increase in probably our second largest cost on the expense side, right? We don't get to just go in and jack up the rent by 60%, right? That would make us terrible people.
Right.
But it's the environment that we're in for the last 18 months where rents have largely flatlined. Yep. I know that's arguable that it's up 2 or up 3%. We're not seeing it. Right. And I think there's always a way to make a set of data tell the story you want it to. But between rent staying the same, insurance going up, especially here in Texas, they're finding ways to really max out on the tax side, let alone inflation impact to other operating expenses. It's certainly a squeeze play right now.
Yeah, I mean you talk about the being able to not manipulate, but be able to present the numbers in any way that you want. It's one of the challenges by looking at these large grouped numbers of like, national rents are flat. That's true. Like that's true. But as we all know, real estate is a highly localized business. I mean, it matters what street corner you're at as to what that performance is going to be. So you can't take these market numbers and immediately go, "Oh, I'm going to apply that to my property," because that's not the way it works.
Yeah,
Right.
National rents is not a very useful metric,
Right?
But it's to your point though. Where we're talking about insurance costs, maybe specifically too, I think another aspect that needs to be heard and the story that needs to be told is, a lot of the narrative is big institution bad. Big institutional investors, whether we agree with that or not, but that's like the story that Main Street gets told, right? And so just to kind of put that out there on the radar, if there's any sector of the market or ownership groups or things like that that are going to have an easier time facing those types of headwinds when it comes to insurance and things like that, it's going to be the institutional side. They've got way more doors. They can diversify. Everything's on a master policy, cost per door and things like that. And insuring comes down. And so if you're looking for more affordable, if you're looking to create more affordability in the market, those owning, under 200 units, those owning the 50 or less assets, right, that don't have on-site management, stuff like that. That's where the insurance costs are going to hit the hardest because they don't have the ability to diversify those insurance costs against a massive portfolio, and their cost per door stays high. And so where you have those pockets where you would be looking for more affordable units, those are the ones that are actually operating on smaller margins right now with these increases. And that's a story that's not being told at all. The little guy who we would, the narrative in the marketplace is that the little guy might be the guy you root for as far as being able to solve some of these problems on a local level. They're getting crushed.
Yeah, and I'm really hoping that after the craziness of November 5th, okay, maybe 2 weeks after November 5th when we figure out who actually is.
Yeah, two weeks after
that the rhetoric around this will start dying down and we'll start looking at real solutions for it. Because, I mean, if you talk about single family homes, there was one bill that fortunately got shot down, but they were defining an institutional investor as someone who owned 10 homes. Like that was an institutional investor.
Wow. Okay.
I'm like, that could be a dentist in Plano.
Absolutely.
So it's this. Unfortunately, there have been these different consulting groups that consult on elections, et cetera, that I get Google alerts on stuff, and they have been raising this as an issue they think can cross over party lines. Yeah, that's why it's being raised so much. Is the strategists have determined, hey, this affects both sides of the line. We can hone in on this, et cetera. I just, again, I hope we get past the election and then we can actually start working towards real solutions to be able to solve some of these problems.
We're undoubtedly going to have to, because there's some black swans waiting in the wings that I think are going to bring a lot of attention to this. So, Florida single family property values is a black swan, I think, that is about to rear its ugly head. And I mean, I listened to this kind of narrative on a different podcast, and then I actually got a call from a personal friend of mine who is selling his home in Florida, moving to Texas because it's flooded twice in the last 5 years. And anyway, obviously, price of insurance, all that type of stuff has him looking elsewhere. You couldn't possibly keep everybody in place in Florida with their rising premiums, and for their homes to stay affordable. And if they become unaffordable to the point where people need to liquidate, the only way to continue to reinsure them after they're sold again is to bring premiums down. That means you have to bring property values down. So there's a really good chance that there'll be a massive depreciation in asset values on the single family side in the state of Florida over the next few years, the point to which it brings national attention to the entire marketplace, multifamily, single family, ever. I think you might see billions and billions in depreciation of single family asset values in Florida. And there's no ignoring that if that happens.
I agree. And I think the compound on that, and I don't know the scale of this, but I'm sure you're aware of that this whole HOA reassessment to fund the
in South Florida. Well, all across
the
Florida.
CapEx across Florida.
Yeah.
Oh, no, I haven't.
We don't have any more
So
skyscraper
there's
collapses.
legislation.
Oh, yeah. No. Okay, now we're
That
talking.
they need to have these HOAs need to fund reserves to avoid collapses. And I mean, we've heard we had lunch with an investor a few weeks ago that these HOAs are going to go through the roof in order to raise the amount of money they need to handle the repairs on some of these older buildings.
Yeah, you've got like sub 50 unit. I don't want to totally butcher the numbers, but you got like sub 50 unit condo buildings that are getting hit for like $400,000 in reserves to get caught up.
Good Lord.
And like their assessments are just skyrocketing.
And you're right. No one's going to afford that. You're gonna have vacant buildings at that point. And back to the home insurance. At some point, though, you got to think about this from an insurance perspective. Of the valuations can come down, but if the valuation comes down below replacement cost, what do you do at that point?
You don't insure it,
right? I mean, you can't. I mean, because an insurance company, you could technically insure for less,
right?
But there's a lot of implications, especially if you get below 80%,
right? On
how things get paid out. Not to go so nerdy on insurance.
No, you're right, because if you're insuring below what it would cost to rebuild, then you're basically in the red as the insurance company if it is a total loss.
Yeah,
is that what you're saying? Yeah.
Well, yeah, exactly. So at some point, are you going to be able to offer, again, to overanalyze this, if your valuation is $200,000, but it costs $250,000 to do the full replacement of it, as an insurance company, I've got to write the premium like it's a $250,000 house.
Right.
That's what that value has to be. So it's going to be that there might be a floor
because you've got a mortgage company that wants a house there.
Right.
So even if it's a total loss, you got to rebuild it. So you've got to insure for the build value.
And the mortgage company has an insurable interest on that. That's the reason they can be on the insurance policy to begin with.
So you could have a huge gap there between what you're insured for and what your house is actually worth. And that's really a big problem, especially if you get another 100-year storm, which seems to be happening every 5 years now.
Or twice in 6 weeks.
Or twice in 6 weeks, you know. That's a really, really interesting part of the story.
Yeah.
So speaking of insurance, let's talk about
You're the king of segues.
I am. You like that? You like that? That's going to be a short. Speaking of insurance, since we have Mr. Andrew Bowen, so tell us a little bit about how the deposit and deposit insurance landscape is changing. So when I first came into this business, there was a little noise about it, right? So this is 2016, 2017. And then I started to look at deals more actively 2020, 2021. And all of a sudden, like deposit insurance was a thing. And now it's a really big thing. But it's changing pretty quickly. You've had some players that came into the market with a lot of gusto and all of a sudden are kind of fading into the distance, and others that are doing very, very well. So we've also been in situations as operators where we've had to lower our security deposit requirements just to get people in the door to stay competitive. So tell us all about that.
Yeah, I want to start with what you just ended with, which was that progression of moving away from the standard deposit. When I first jumped over, and you know me, I'm a data nerd. Like I want to go in.
You said it, not me.
It's fine. I own it. I've owned it for a long time. I started looking at the trends, and I looked at data from a couple different sources, and I started looking back in 2010 when I left operations. Because when I left operations, the standard deposit was 1 month.
Yeah,
like that. Anyway, it was
for a long time.
Yeah, it was a 1 month deposit back in 2010. Rents back in 2010 average. I know you don't like the national number, but that's the number I have. It averaged about $1,600. And you fast forward to 2024. I actually did the data through 2023. And we looked at, all because we see, hundreds of thousands of units of what are the standard deposits of what we do. The average is, and I'm being generous with this, so I would really actually say the one we see the most often is $500 on that. So if you take that from going from 1 month to $500, which is basically a week, because average rents are about $2,000 nationally, it was basically a strategy to do what you described. People were trying to buy occupancy.
Yep.
Right. We're going to make the barrier to entry for residents from a cash perspective easier, which candidly we need to do as an industry, because there's a report by Forbes that the average American, I think it's 70% of Americans have less than $1,000 in savings. Wow. So they can't put together a month deposit. By the way, that strategy worked. We went from 93.8 in occupancy in 2010 to 94.8 in 2023. We also saw average bad debt go from about 50 to 75 basis points to 1.5 to 2%. So we bought a point of occupancy and we increased bad debt by a full percentage point. So basically, we did it for nothing at that point, which is where deposit insurance versus some of the other deposit alternatives out there comes into play. So there's a couple different, there's about like 3 basic models of it. There is the surety bond model, which is underwriting a resident and saying, okay, if they don't pay, we've got this taken care of. There is the line of credit model, which is the same thing. And again, both those models are, okay, if someone's not qualifying, how do we help you get them past the barrier of having the extra cash? So again, it's essentially buying occupancy.
Let's explain the line of credit model.
Well, it's not my model, so I can't fully do it. But basically it is, there's a couple groups out there that are working with banks that have basically said, okay, because we've underwritten this resident, we said, yes, we're going to issue essentially a guaranteed line of credit of X amount of dollars. In case they need it for that deposit at the end. One of the challenges with that model is it's only for the first lease. So what happens when they renew? Now you've got all the exposure. But the way that true deposit insurance works is it's we're going to offer, instead of an opt-in, it's an opt-out. So we're going to spread that risk, kind of like we talked about earlier, of spreading the price from the Florida into Washington. We're going to spread it across the entire property. So get 90% enrollment, which is pretty standard for what we see on our properties that are doing it well. And we're going to spread that through a monthly deposit waiver fee. So from a competitive perspective, it allows you to basically offer a 0 deposit. So now you're actually the lead competitor in the space. Great, you can do 500 here, or for a monthly fee on this one, you can be able to do it on this. From an ownership perspective, it means that from a bad debt coverage, instead of doing 500, you might be able to have because you as owners select what coverage they want. That may be 1,500, 2,500. We underwrite deals. The way this model works is you underwrite the property, and it essentially operates like health insurance does. You and I used to work at the same company together. So I will absolutely guarantee that my time at that company, I cost them way more in medical expenses than you did. Between having a wife who had breast cancer, I had a cardiac issue that involved helicoptering me from between hospitals. My son had a weird diagnosis. So I know that my expenses were 6 figures several different years. Assuming we picked the same plan, you and I paid the same amount. Because again, we're spreading that risk over the entirety of it. So it's one of the things that attracted me over to this. As I looked at it, it was like, okay, this is a model that benefits owners because it does remove a major barrier to leasing. It also protects your back end. So now that 1.5, 2 percentage points of bad debt that lowering deposits has basically created, you have a way to ensure that now. But it's still also doing good for the residents. It's giving them a pathway to get to that next property that they might not have been able to go to because they don't have, first month hookup fees, renting the truck, all those types of things. So
100%. Yeah. And I mean, the more that obviously we've been customers on our assets as well.
We appreciate it.
Absolutely. I mean, I see it becoming industry standard very quickly. I just think as far as affordability goes, we talk about affordability in a very general sense, meaning we talk about it mostly involving rental rates. We talk very little in this industry about the barriers to a lease. And that's a huge component of affordability as well. Affordability is not just what I'm paying every month. Affordability is what it costs me to get into the property on day one. And that has been a huge barrier for keeping occupancy at a stabilized level because it's a lot of upfront money for most people to get in. Yeah.
And one of my favorite, not anecdotes, one of my favorite stories that shortly after I started, we had a new partner that was onboarding their properties. And we got a story from one of the community managers that as they were signing the lease with the resident that was coming in, and they were explaining the program, that the resident burst into tears because she was fully expecting that she had to pay a deposit. And she had literally said, she's like, okay, now I can rent a truck. That's the kind of story that, is why we do what we do at that point. To be able to, it seems like something so minor to some of us. Like I've got 2 kids in and out of student housing and things. I've rented more U-Hauls in the last 3 years than I can count. But to have that burden lifted, where you do have that just a little bit of breathing room to do what she was considering was a luxury. It meant everything to us.
That's awesome.
Yeah.
It's all about, I mean, when you say like that, we tend to have to check ourselves once in a while to like take the owner operator hat off and really kind of talk about making things easier and better for our residents. But like, those are the ones that really kind of touch your heart, right?
Yeah.
One of the things I wanted to ask you about your product is about fraud.
Sure.
Okay. So fraud is rampant right now. You got TikTok channels and Instagram ads on helping people commit fraud and stuff like that.
Yep.
Are you guys seeing that on the deposit insurance side too, or is it just kind of on the upfront resident piece?
No, we're not really necessarily. I mean, we see the after effect of it, obviously, because if they've moved in, and again, the way we do this, we don't pass the, like, our relationship is not with the resident. Our relationship is with the owner. It's a business to business platform. It's one of the big differences between deposit insurance and, you know, deposit alternatives. Deposit alternatives are platforms that will have that direct relationship with the renter.
Got it.
There are some potential challenges there. Like, I mean, now you're running their credit twice, so you're dinging them. So all that positive rent reporting you're doing, you're dinging them twice for your credit. In that relationship, they're typically also doing what's called subrogation against the resident. If the resident doesn't end up paying, you know, the damages, deposits, rents, all those kind of things that are in there, they're going to go back and sue them. You know, and kind of that's not the way deposit insurance works. Right. You know, I didn't get sued because I had a helicopter ride. Thank God, because that was an expensive helicopter ride. So yeah, we see the after effect of it from a claims perspective, because what a owner is ensuring is that person's going to pay the full balance of what they owe across the lifetime of their lease, and we're going to cover, you know, within certain boundaries what is not paid. You know, especially from a rent or a damages perspective, fees are a slightly different conversation. So yeah, we see the after effect. We don't necessarily see it from residents directly trying to commit fraud against us, because they typically don't know we exist.
Got it.
Yeah.
Okay. So look, I've known you for a while,
Yeah.
right? And I've seen you firsthand with customers, and we've done deals together. We've been in sales cycles together and had some great wins together too, right?
Yep.
As you look forward to this new opportunity, what are you excited about?
I'm excited what you actually just said. And that is, I think this is an area of opportunity to truly change the way the industry operates, that is kind of being forced anyways.
Yeah.
You know, you mentioned it, you know, with the market's not going to bear this. Well, that's only going to continue to develop. I've been blessed in the areas of where I've worked on the supplier vendor side of the business to really be in areas that have that benefit to owners, operators, and residents. It's one of the criteria that when I was recruited over LeaseLock, I was like, okay, well, show me those three things, because I can't work in another environment. I got too much that's buried in me. But that's what I'm the most excited about. I'm excited about the fact that this is an area where the industry is changing anyways. And the way it's changing without a product like ours is just passing all of the risk and all of the danger over to the owners. The owners are just having to eat this. Yep. That's what insurance is. Insurance by definition is the transfer of risk.
Sure.
So that's where I'm excited to have that. The other thing I'm excited about, honestly, is done right and done extensively, it removes all of the liability around deposit management off your teams as well. I mean, I know there's areas around Chicago where, not because deposits are illegal, but because the penalties of mishandling them are so onerous.
Oh yeah.
Nobody does deposits up there. They don't really. They will do a move-in fee, but there's 2 or 3 law firms out there that all they do is do deposit mishandling, and the penalties are like 3-4x the deposit.
Oh yeah.
You know, by not doing the interest on the right date. Like, I mean, it's crazy.
Wow.
So I mean, operators up there have decided it's not worth the liability. So how can we, through a couple different things, we've got a partnership with another organization that literally handles the few deposits because people still have to have the opportunity to pay a deposit. They'll handle it all, and they know all the legislation, et cetera. So it removes that liability completely from the operator.
That's a really interesting point. Just removing that layer, just that layer of headaches. We run a single family management company. And I will tell you that on the single family side, that's one of the things that is a massive headache at scale, is being caught in the middle of tenant and owner disputes around deposits.
Sure.
Obviously mishandling and things like that. You want to be very cognizant there, but when a tenant goes after an owner because they didn't want to return a deposit, your management company is the first one to get named in the suit as well.
Yeah.
And you have very little control over it. I can't give back money that an owner didn't approve for me to give. It's a conversation we're fostering, but it is the owner's property. And so it's just being able to remove that layer of headaches is tremendous. It's kind of a silent benefit that we don't talk about a lot, but yeah, those are that litigation side is just something you don't even want to have to worry about if you can minimize those headaches.
Agreed. Yeah, totally agree.
Love it. So we want to get you out of here on time, Andrew. But tell us about the show. So the reason I reached out to you is because I saw you on LinkedIn, like unpacking your new microphone. And it reminded me of the joy that we saw on Jesse's face when he unboxed these wonderful microphones.
And by the way, they're the same microphones. Like I did
great. Sharing the same joy. Unbelievable.
Absolutely. So one of the things I have had the absolute pleasure of being able to do both in my previous life and this life is have interesting conversations like this. So one of the things that we've started off at LeaseLock is our podcast called Unscripted. You can find it on Spotify, on YouTube. I think it's going to be released on Apple this upcoming season, et cetera. And we've really focused it in on, okay, how can we have conversations around the people of real estate? And that's kind of the one we're on right now. Different seasons will have different phrases or different shows on it, but it's going to be anywhere between a 30-minute to an hour-long conversation with someone either in or around real estate. It's not a testimonial podcast. That's not what it's about. It's about bringing interesting stories to bear. I think episode 2 was Jennifer Sochokas, where we talked about building a people first culture. Episode 4 was a gentleman I've known for a long time, Chris Lemma, who's the CEO of Motivations AI. It's a personality profile, but we really talked about specialization and how you need to think about hiring differently and evaluating employees. And where they fit within an organization. So it's conversations like that. Like I'm excited to have one coming up that is with someone who is very heavy in the BI space for an operator, but we're going to talk about IQ versus EQ. Like how do you balance those two from that perspective? So that's kind of the unscripted one. Again, it's available on all the platforms. One of the ones you asked about, Optech. I'll do a pitch on one of them. One of my favorite episodes I've actually ever done for any of these is we brought together quote unquote 4 LinkedIn influencers. I was one of them who brought in, but then we had Don Beveridge from 20 for 20, Devin Wirt from Connexus, and Mike Wilbur, the chief sales officer over at Apartment List. And we got together at Optech and talked about what is thought leadership. Like how do you bring it? How's your social media? How do you create a personal brand social media strategy? How does that bear with your actual? And you guys will get this. How does that bear with your company strategy? And how do you weave those two together? So it's conversations like that we want to get. I don't have a studio quite this nice. We've done a lot of ours on site, and shout out to Jesse because I can't tell you how valuable someone like him is. Actually, I can tell you. I have 2 episodes that literally don't have video on them because the video crew would just messed everything up. By the way, the video crew was me by myself. So yeah, shout out to what's going on. But it's a lot of fun, and I enjoy having the conversation. So you're
really good at it too. I mean, I've seen a bunch of your episodes, right? I got to catch up on the unscripted, but I've seen you in action before, and you definitely know your stuff, man.
I appreciate that.
Absolutely. So as we wrap up here, thank you.
Of course. No, thank you for the invite.
Definitely appreciate you coming down here, joining us live, taking the bear seat, right? Nick usually sits there. He's a large human being.
I'm kicking people out. It's all good.
Where can people find you?
Probably the easiest one is on LinkedIn. Andrew Bowen on LinkedIn. Obviously, you can bring LeaseLock.com is where you can definitely connect with me as well. And then I've got a personal site that I woefully undermanaged, which is andrew-bowen.com.
All right.
Awesome.
Got all 3. Andrew-bowen.com. Go and leave some feedback there first. Now find him on LinkedIn. Check out LeaseLock. Check out Tour Studios, TRE Studios, and deepbluere.com, the home of Deep Blue Capital. Boys, this was a good one.
This was good.
It's good to be back.
It is good to be back.
We got a double header today I'm excited about.
Yeah.
Yeah, we'll be here all day.
That's it. I'm excited. And
Andrew, thanks you again, man. Really, really appreciate the time.
No, I appreciate it, guys. Thanks.
awesome.